Hi, everyone. Thanks for joining us today for the Briefing Trader webinar on Under the Radar Plays on New Administration Policies. I'm Mike Midland, and I'm the contact person for those of you taking a trial on Briefing Trader. Today, we're going to have senior analyst Robert Reid, who trades and posts under FUNDX, give us his list of new administration picks for 2017. Robert's coming off a huge 2016 with two doubles among his picks in his current portfolio. Seagate is up 124%, TrueCar is up 103%, as well as Max Linear up 43%, and Sapiens up 32%. So with the Briefing Trader trial ending, I just wanted to thank everyone for taking the trial and checking out Briefing Trader. Hopefully you all enjoyed the trading and investing calls, proprietary research, as well as the educational aspect to our service. I also wanted to mention that everyone who's taking a trial, the trial is going to expire tonight, and we're offering the lowest annual pricing with our annual promotion. So if you have any questions about the end of the trial regarding Briefing Trader or anything on a subscription, you can contact me at mmidland@briefing.com. That's mmidland@briefing.com. And also, for any of our current subscribers, feel free to reach out for a short demo on how to optimize your trader service. We'll also be having another webinar on March 16th. This is going to be our first roundtable discussion in Q&A format. We'll have senior traders event, chart, and tech tea there. We're going to be discussing current market themes, strategies, and answering specific trading questions, so be sure to register for this. Finally, if you'd like to ask Robert a question, just use the chat window on the left, and he'll try to get to as many as possible and get back to you by email or post the answers live on the site to any you can't get to today. Okay, with that, I'm going to hand it off to Robert now.
Okay, thanks, Mike. I appreciate it. Hi, my name is Robert Reid. This is my first webinar, so bear with me if there's any issues. But anyway, I just wanted to kind of describe who I am and kind of what my professional background is and what my trading style is. And then I'll talk a little bit about the election and, potentially some plays that we can have that I think I'll do well, not necessarily over the next month or so, but over the next few years. And I broke them up by like financial, regulatory, and then infrastructure. And then we can have a little Q&A at the end if we get some questions. Okay, well, let me go ahead and get started. Just a little bit about me. My background, I worked for a law firm in Chicago, and then I took a job with Citigroup. It used to be called Salomon Smith Barney back then in the late 90s. And I worked under highly ranked sell-side research analyst in the steel industry. So I kind of know the steel industry pretty well and the metals industry. But it's a good industry to kind of cut your teeth on because you kind of learn about cyclical indices in general, cyclical stocks in general. And it kind of can apply to a lot of different areas. So I did have a good time doing that. And then I joined Briefing in 2000, actually, as one of the first hires when the company moved from San Francisco to Chicago. I was one of the first ones here. I have undergrad in finance. I have a law degree as well. And I'm currently a senior equity analyst is my current title. So, and just for what I do at Briefing, just kind of give a little more of detail. I work a lot of the emerging growth system. That's the GrowX. I'm kind of in charge of that. And then I also work a lot on Trader. I do story stocks. I help with IPOs. And a lot of those sources are great for me for what I buy in FUNDX because a lot of the stuff I go through, emerging growth kind of has me look at a whole bunch of different stocks. And I kind of pick the ones I really like and potentially buy them as FUNDX through my Trader thing. So it's kind of all connected in that way. So let me talk a little about my trading style. I'm definitely more on the fundamental side. I mean, I do take technicals into account, but I would definitely say the fundamentals are definitely more, probably 80% of what I look at. And it's, technicals do come into it to some degree, but I'm not a technician. I'm more of a fundamental guy. Like I really understand financial statements, balance sheets, income statements, margins. That's kind of what drives me, and then of course valuation metrics, things like that. So that's kind of what I look for. In terms of the kind of stocks I look for stocks with just good stories. And I know that sounds obvious and everything, but a lot of companies aren't, you can kind of see through, maybe their potential isn't quite as good as what you would expect it would be. So in addition to And another thing I do is I rely on just transcripts. I think, I'm sure a lot of you listen to earnings calls. They're extremely helpful, especially the Q&A. You kind of get a good sense from management, like which management's competent, which ones are perhaps not, and which ones are honest and which ones are not. So it's kind of a good way to learn about a company just in that sense. So I do rely a lot on the transcripts and on the, on the earnings calls themselves. I do highly recommend plugging into the webcast when a company does have a call. A couple other things. Another thing is I'm kind of a margin person too. I love, to me, $1 of revenue is not all equal. If you're making a 2% margin, that's not as good as a 20 to 25% margin. So a multiple should be higher on a higher margin company, and it just brings in a lot more cash. I'm a huge adjusted EBITDA margin guy. I really like to see some robust numbers there. So that's something that I look at. I also look at balance sheets. I like to see a high cash balance, low debt. But not always. I mean, there's definitely, examples where I kind of veer from that. For the most part, I do prefer to see some nice balance sheets there. And finally, just in terms of time frames, I'm not a day trader. I am more of a swing ideas guy. These ideas could maybe take 6 to 9 months to play out. I mostly scale in and scale out. I don't just jump all the way in or go all the way out. I usually have about a 20% stop loss limit when I purchase a stock, because these are swing ideas. They need kind of room to trade around, so I don't want to be too tight on them. I used to be really tight with maybe a 10% stop loss limit, and I would get stepped out on an idea, then it might go up 40% from then. Or I might have a bad quarter, but I don't play one quarter. I look for good stories that I can play over several months. And I think that's kind of why, depending on, I don't know what your trading strategy is, but if you're not someone who sits at the computer screen all day long, then I'm probably a good person for you to follow, because I'll just buy things a little bit here and there. You don't have to watch the screen every day. I'll hold them through earnings. I'm not buying and selling into earnings, that kind of thing. So that's kind of my strategy. Now let's kind of turn to kind of the meat and bones of the presentation here today. So we're having this webinar today because it's actually good timing, because actually President Trump is addressing Congress tonight. So I imagine he's going to mention a lot of things about infrastructure, about tax policy, about health care, about regulatory changes. It's a good timing in terms of kind of get a sense for a way to potentially play it. But I can kind of estimate what he's going to say. He's going to want infrastructure. He's going to want higher defense spending, cut taxes, things like that. So that's why we're talking today. And the other big change is everyone talks about how Trump got elected, and it was a surprise. But the other big change that people don't really talk about it much is that we now have a unified Congress. So depending on where you are politically, that's not what we're going to get into here, but it's more when one party controls, things can actually get done. So we could actually maybe see some things actually finally get through. So that's a good sense too. So that's the other big change. And also, I think it's going to last for a good 4 years, because the Senate is probably going to stay in GOP control in the 2018 midterms. Just the way that all the states are lined up, it's a lot of blue states are up for re-election, and a lot of the safe Republican seats, or the vulnerable Republicans, are not really they're not really up for election this cycle. So just sort of my overall look on what to expect with the new administration. Obviously, taxes are probably going to get cut. Regulatory issues are going to be more lax, I would say. Trade is going to be more protectionist. I think there's going to be more. I think it's better for U.S. manufacturers in that sense, especially my background coming from the steel industry. These Nucor and Steel Dynamics, they complain about imports all the time. So definitely should help them to cut back on some of these imports, and these cheap imports. And obviously another thing is the infrastructure bill. Hopefully it can get passed. There sounds like there's some debate whether or not that's going to happen, because there's some people are deciding on how to pay for it, even among the Republicans. Some want it to be more private. Some want just to load it up on the deficit. So hopefully they can get some sort of an arrangement together to start, getting some infrastructure out there, because our roads, bridges, airports, ports definitely need some upgrading. And another thing about the other thing that's probably going to happen is the corporate tax rate is probably going to get cut. It's around 40% now. It's probably going to get cut about 20%. They talk about 15. I think 20 is more likely. But another thing that people don't talk about is, you know, the stock market's done so well the past few months, but I think a lot of it has to do, definitely there's some, you know, economic stimulus out there, and that's definitely good, but also just a lower corporate tax rate. You go to 40, 20%, EPS numbers are going to go up big. And I think a lot of traders are taking that into account where, let's say if a company earned $3 a share in 2016, they might earn $3.70 a share or whatever in 2017, even though their business hasn't changed. So when you add the same PE multiple onto that, that's going to bump up that stock price. So I think a lot of the movement is related to that as well. It doesn't get much press coverage, but I think those PE multiples, and I'm a value guy, so I think that's kind of what's driving it as well. With that said, I don't think those are the highest quality earnings. You kind of want to see companies, you know, you want their EPS to go because their business is growing, not because of its lower tax rate. But with that said, the EPS definitely will go up, and it should change those multiples. And a final note, but then the downside is, you know, with all this economic stimulus, it's great and everything, but higher deficits, higher risk of inflation, higher interest rates, and, you know, to be honest, Trump can be a little unpredictable. So I'm a little concerned about the geopolitical risk. You know, if North Korea starts firing weapons, are we going to start, you know, who knows what that might get into, or if somebody tweets something that could set them off. So I don't know. It's just, you know, it's just a little bit, the risk goes up in my mind. So I think that reality might set in later this spring or the summer when kind of all this comes together, and, you know, hopefully everything goes well. But, you know, it's just something to keep in mind. So with that said, I wanted to kind of maybe talk about some ways to maybe play the next 4 years or so. So today I'm going to start with, I kind of broke them into financial and regulatory plays and infrastructure. So starting with the financial and regulatory, the first one I want to talk about is Sallie Mae. And I know Fannie Mae, Freddie Mac, all those stocks got hit a couple of weeks ago on that lawsuit that didn't go their way. But just so you know, Sallie Mae is not a GSE. It used to be back in the day, but it's not anymore. They terminated their federal charter in 2004. So they are strictly, they do originate and they service private loans to students for their college education, but it's all private. It's not backed by a government, by federal or state. It's just, you know, it's just private lenders that are out there doing it. And then actually in 2014, SLM actually split into two publicly traded companies. There was Navient, which is an education loan management and servicing and asset recovery business, and then SLM is the consumer banking business. And SLM loans are kind of known for primarily bridging the gap between what's not covered by financial aid and then what comes out with and federal loans. This sort of like plays the gap there. And I see it as a Trump play because I think that a scaled-back government, I think a scaled-back government student loan program is what Trump and them are going to do. I think that they're going to shift the risk from government backing it to more private lending. And that could be a potential windfall for Sallie Mae because they do they issue more than half of all private loans for college. So they should definitely benefit from if there's a shift towards more private lending. And they also should benefit from a lower regulatory environment generally. The other and then here's the chart on it too. You can see it has done really well in since the election, since the surprise election. But if you look at it, it's only, you know, a couple of points above where it was in mid-2015. So you know, so I don't think it's totally outrageous. And a lot of times these stocks, they might pop and then pull back and then but keep going farther when the fundamentals are there. And I think that the you know, for stocks like this, the fundamentals are there. So I wouldn't be too concerned about the huge spike recently. Now, the other one that I kind of liked in the financial regulatory area is Greenhill. Basically, they are an investment bank, but they're a little bit different than most other banks because all they do is advise. They do not do investing and trading and sell-side research and lending and underwriting and commercial banking. So I like that because it reduces the risk. So if the market goes down or the IPO market blows up, or basically Greenhill is tied to M&A. So more M&A, that's good for them. Less M&A is bad for them. So I think that that's why it's attractive to me. And another reason is that because they don't do anything, they're not trying to sell anything, they don't have conflicts of interest, and their clients are generally stable, and they stay with them because they know they're not going to try to sell them something they don't want. So that's an attractive thing about Greenhill that I like, and I think that their clients feel that way as well. And I think it's a Trump play because I think there's going to be a much more favorable environment for M&A in general, and I think that that's going to help a company like Greenhill. I think it's and also you might think, like, let's say a company might think, oh well, let's say two companies were thinking about merging, and they were thinking, oh well, we may not pass antitrust muster, but now I kind of sense the antitrust hurdles are going to be lowered. I think that the FTC is going to allow more combinations of the FTC in terms of allowing companies to merge that perhaps may not have been able to merge before. Like all these cable companies and like Humana, and I wonder if they're going to try to come back to the table in a year or two to see if they can merge. But anyway, from a broader sense, I think that there's going to be more M&A coming down the pike. So I think that's good for a company like Greenhill. So that's why I kind of have a play on it. And also, if you look at the chart, it has moved up, but it's still well below where it was, even in mid 2015. It was trading in the 36 range, and now it's at about 30, a little like 29 area. So even though it has definitely moved up since the election and since last summer, I still think I still like it here. I think it's still a good buy in this this environment with Trump. So let's move on to sort of my infrastructure plays, and obviously there's a ton here to choose from, but the ones that kind of stood out to me that I think are worth mentioning are Mastech, Steel Dynamics, of course I'm a steel guy, Titan International, and there's GenCore. So let's kind of go through these and kind of explain what they do and why I think that they might be good plays over the next few years. So let's start with Mastech. So basically what they do is they provide infrastructure construction services. So they dig trenches, lay cable, get cell towers running. They install and maintain oil and gas pipelines. They do a lot of stuff. And I remember like a decade ago, they were basically just a DirecTV installer. But they've acquired a lot of companies, and they've really expanded their services to a whole bunch of different areas. So now they do a lot more than just that. They do have a lot of wireless exposure, but they also have a lot more. They've been a lot more into oil and gas, and I think that has been a weak area for them over the last year or so. But I think that they're really going to, they're starting to see some improvement in that area. So I do like Mastech, and also the company is extremely well run. I listen to these conference calls, and these people, you just kind of can tell they're very competent. They know what they're doing. So I feel, and I don't say that about every company, but this management kind of strikes me as, they know what they're doing, so I'm happy to see that. There's a big increase in oil and gas and infrastructure spending that should benefit MTZ. They also have been involved in the Dakota Access project, which they're specifically involved in. They can't really go into too much detail into everything they do, but they do. The Dakota Access is something that they are involved with, and that's a big deal. And it's not just that. I mean, I was on their last conference call, and they were saying that. And this is kind of what stuck out to me, was just kind of a comment. They're saying that they had these projects. They've been in like several projects that have been in the works for several years, but they've been just kind of waiting to get approved, whether environmental or regulatory issues came up. And those projects are starting to come to fruition, and they're coming close to entering the construction phase. And that's great for Mastech. That's what they do. So they're saying that there's a whole bunch of projects like this, large projects, that are going to come to fruition in 2017 to 2019, so the next 3 years or so. And so I definitely think it's great for a company like Mastech, and that's why I put them on the list. I actually put them first, because actually I think they're going to be the best infrastructure play out there, one of the best. And it's not just a near-term thing. It sounds like the next 3 years they're going to have a lot of projects to work on. So that's why I like it. And also just I think that the Trump administration, I think his energy department is going to be a lot more favorable in terms of approving oil and gas pipelines, not just the big ones we know, but just kind of smaller pipelines along the East Coast and other areas as well, not just the Dakota pipeline and going up to Canada. So anyway, overall, I do like MESTEC, and I like these big projects. They're coming to tuition. It's going to be a tailwind for them. And you can see in the chart, yeah, it has come up since the election, but I still like it. I think it's up 8 points since then, but it's still. I think over the next few years, it's not just I don't think they're not going to just sell off. I mean, I think they're a quality company, and they've got a lot of projects in the works. They just reported a big Q4. I think it was this week or last week that was really impressive, and it sounds like business is really booming right now, so that's definitely a good thing to see. And then the next infrastructure player I wanted to talk about was Steel Dynamics. Again, I worked on the south side with Citigroup, and steel was my sector. And of all the steel stocks, I love Steel Dynamics the best. It's probably my favorite steel stock. They are, just to step back a little bit, there's two types of steel producers. They're not all the same. There are mini mills and there are integrated producers. The mini mills, what they do is they make steel mostly from scrap, from like junkyards and just old, basically just a whole bunch of different sources they get their scrap metal from. And they melt it down, and they do add other things to it, and some iron, and they come out with steel that way. The other way is the integrated producers, and what they do is they create steel from the raw materials, from iron ore or coke, and they just blast it together. They're not recycling. I mean, they're creating steel from their organic properties. And they take these like coal, iron ore, coke. They put them but then they put them in this huge blast furnace, and it just churns and churns and churns and puts out a ton of steel. The advantage for the mini mills is that they, a few things. First of all, they can stop and start demand based on, like if demand's down, they can cut back on production, whereas unlike an integrated producer, shutting down the blast furnace is a huge deal. You can't just turn it off and turn it on. You have to plan for it, and it takes forever to turn it back on. I mean, it's basically a lot. It's just a much bigger process. So the mini mills are more attractive in that way. I mean, I remember when I was at Citigroup, I remember the integrated producers always say, well, the mini mills, their steel is not as high quality, but definitely I think the gap has closed. I think the mini mill steel is just as good quality as the integrated producers, because the technology has advanced over the last decade or so. So mini mills are kind of pretty much on par with what the integrated producers do in terms of quality. Steel, and of them, I do like Steel Dynamics. Again, they're much more efficient. They can, obviously they don't have, and also mini mills don't have, they usually use non-union labor, whereas the integrateds usually use union labor, so there's cost savings there. And I was on Steel Dynamics call for Q4, and it sounds like 2017 is going to be a pretty good year. They're saying the automotive production levels might be coming off record levels, but even if they match 2016, that's really good because automotive was extremely strong in 2016. They're also talking about, the construction sector is getting better, especially for larger public sector infrastructure projects. Again, hopefully this infrastructure bill gets through. They also expect some improvement in the energy sector as well, which has kind of been weighing them down. But and just to kind of put a little bit in perspective, actually Nucor had talked about this on their recent call, was that they talked about how a $1 trillion infrastructure bill over 10 years would be have a huge impact on steel consumption. It'd be about 50 million tons for each trillion spent, so about 5 million tons per year, and right now about 100 million tons are consumed in the U.S. each year. So another 5% is good. It may not sound like a lot, but for the steel industry, that's a lot. That would have a big impact on results. Adding an extra 5 million tons of consumption would definitely be good for the steel sector. And then within the steel sector, I just like Steel Dynamics. I like their management. I like their balance sheet's in good shape. They recently made some some good acquisitions, and just overall they're doing a great job. So I'm really happy. I do like Steel Dynamics. I feel comfortable with that one. And then I'll show you the chart. Again, it has come up again on the infrastructure, but you know, it's still a decent price. It's still not as high as it was back in 2008. I know the stock then it traded about 40 briefly in mid 2008. So you know, it definitely is on the higher side, but I just like the fundamentals, and it sounds like, you know, the next year or two, and especially the infrastructure bill comes through, that's definitely good for Steel Dynamics. So that's the name I do like. Now the next one I want to talk about is Titan International. What they do is they make these huge wheels and tires, at least for these off-road vehicles. Maybe for the agricultural market, for construction. They do have some consumer markets, but it's mainly for huge off-road vehicles. And in fact, it's one of the few companies dedicated to off-wheel wheels and tires. And wheels and tires are not the same thing. You put tires on wheels. So anyway, I like Titan. Kind of interested me for a few reasons. I like it because it's a turnaround play. In addition to being a trade play and an infrastructure play, it kind of hit a few buttons for me that I like. It's a turnaround play because right now Titan's kind of their industry has been basically decimated, a lot by imports, a lot just by lower demand. They're in the midst of a 4-year down cycle, but the manager was pretty positive on their last call. They were saying they're kind of bouncing around the bottom. They're not saying they necessarily have seen bottom for sure, but they're definitely towards the bottom, and they're kind of they can kind of see the light at the end of the tunnel was kind of the way I read into it. And definitely the downturn of the ag business, they said that has stabilized. I mean, that's been really weak for them for a long time. And, you know, the construction market should get a boost for the higher infrastructure spending. Again, if that bill comes through, that would be definitely good for them. And just on the trade, they would be helped probably more than most other companies because cheap imports have just decimated them. Just, you know, these tires were coming in, I think, from China and from parts of like India, and you know, Titan was having trouble, you know, just surviving in this market. But I think I know they recently won some trade cases in front of the ITC. I'd have to dig into a little bit more, but I know that there were some positive developments, and there might be some final duties imposed. And you know, the Trump administration is going to be all for imposing more duties if it comes to that. So. And finally, I just want to mention on Titan is they have what is called this LSW wheel technology. Again, I'm not an expert in wheels or tires or anything, but basically it adds fuel saving, speed, and durability to these huge tires. And Titan said that they were pretty firm. They're saying like any farm with 1,000 or more acres should change to LSU ASAP because there's a tremendous amount of savings, especially if you've got a huge farm. And they said that the recent trade show was really, really positive. So they're really kind of positive heading into this next crop planting season, which should be starting soon. So that's definitely a positive. Now, again, they report earnings on March 15th, so just keep that in mind. Hopefully it's a good quarter, but they do report in a couple of weeks. And a final thing with them is they've hired a new CEO and a new CFO just in the past few months, and it's always good to get some fresh blood in there and you know, to get a company turned around. So I do kind of like that with them. And let's look at the chart. Again, the chart, they had a huge dip, but again, they're only back to kind of where they were in 2015. So even though the stock has come back, it was down really low in early 2016. That's when the imports were just, you know, coming fast and furious. But so the business has improved. But if you look at the longer-term chart, and I'm kind of a longer-term guy, you know, this was a $25, $30 stock in 2012. So even though it's up at 13, it's still way off where it was even just a few years ago. Yeah, it was trading above 30 in 2011. It hit 30 in 2012. It was in the high 20s or the early part of 2013. So it has moved up, granted off its super lows, but it's you know, trading at 13. I think it's still, you know, it's got some upside. I think it's a good turnaround play. I think it's an infrastructure play. I think it's a trade play. So I do like that one as well. I've been kind of keeping an eye on it for the past few years. I mean, I obviously wish I bought it at 4 or 5, but it was just, their outlook was just really horrible back then. There was some discussion that they might go under, but there were some fears of that. But So anyway, so let's move on to the next one. The next one is GenCore, and this one is a little bit, probably a little more speculative. I was kind of debating whether to put it in the presentation or not. I do like it for a few reasons. First of all, they make machines that produce asphalt. In fact, the company believes it has the largest installed base of asphalt production plants in the U.S. So I like it. So you can't get any more of a direct play in infrastructure than asphalt. I mean, if they're going to do roads and highways, they need asphalt. So that's great for GenCore. And that's the reason I like it. I like it because a lot of people don't know it. You know, people know the big names in you know, highway construction, that kind of thing. But GenCore is kind of like an under the radar name that I think is a direct play if that infrastructure bill comes through. Again, all of this is contingent on the infrastructure bill getting passed. You know, that's definitely not guaranteed. You know, and also may not get passed at $1 trillion, might be less. So that's just something to be, you know, just keep the back of your mind. Like, obviously, no one really knows what's going to happen, to be sure. But they are currently benefiting from, there was a smaller infrastructure bill that passed in late 2015. That was a $305 billion, the FAST Act infrastructure bill. And GenCore says they are benefiting from that. So if we could pass a $1 trillion bill, that would be another big boost for them. So they'd be a direct beneficiary, so I do like that. And in fact, GenCore is pretty excited too. They say their industry has been rejuvenated, and they increased their manufacturing headcount by 30%, which always is a good sign to me. Like, they're confident in their business in the next year or two that they're going to hire that many people. They have 2 facilities in Iowa and Florida, and they're going to increase 30% at both of them. So I definitely think that's a good sign for GenCore. With that said, I do think GenCore is more on the speculative side because it is very thinly traded, and I'm always afraid to put out thinly traded stocks because just a few purchases here and there can move them. It also has a small float, so it's just a small size. I think they have less than $100 million in revenue, but they're small. But anyway, I just wanted to put it out there. You know, it's this kind of name you're not going to be able to trade in and out with size, but it's just kind of a name I think that's, you know, not well known. Definitely a play on infrastructure if that bill can get through. So anyway, I just wanted to put the name in front of you. And that's the chart on it. And again, it's kind of pulled back in the last couple of weeks. It did move up on the election, but it's not like crazy, you know, it didn't like spike on it. So again, I don't think that a lot of people really follow this name. That's kind of what drew me to it. So let's go to the next one. The next one is, if you're not comfortable holding stocks, and there's a lot of people who are not, then I think that you might want to consider this. It's called EWW. It's iShares Mexico. A chart trader, at briefing, he put the name on my radar, so it was his idea. But I just wanted the more I kind of looked into it myself, and I do like it. I was kind of looking for an ETF that I wanted to share with you guys, and you know, I think EWW kind of fits the bill. I think the Mexico sentiment has been so horrible that, you know, the stock where it's trading at now, it's just an attractive contrarian play. I mean, this ETF, it was trading in the low 70s as recently as early 2013. So, you know, now it's trading at 46. So I think, you know, I think I like it if you prefer an ETF. To me, it's an attractive ETF. You're looking for sort of a you know, a contrarian play in this area, because I think that, you know, all the criticism Mexico's taken is just not really warranted. So anyway, I just want to put the name in front of you, and Chart Trader did a great job on that. So, but I wanted to just at least share it with you guys. And another one that, again, is speculative, but I wanted to just at least throw it out there, it's called Ramaco Resources, and its ticker is METC, which is kind of funny because it means met coal. Basically, they're kind of a development stage company. They're a coal company, and they're attractive because, well, let me step back a little bit. There's basically 2 types of coal. There's thermal coal and there's metallurgical coal, or met coal is what it's kind of commonly referred to. Thermal coal is used for utilities to generate to create electricity for consumers, whereas met coal is used to create steel. There are different properties for the different types of coal, and met coal is used to create steel. And that's kind of why I like this. So it's kind of hitting two things there. First of all, it's a coal play, which Trump loves. No regulations on coal. They're going to bring back the business. Okay, great. And they're feeding into the steel industry, which I like as well. And I think the steel industry is going to have a good year in 2017, 2018 for all the reasons I talked about when I talked about steel dynamics. So like Met-C would produce steel that would go to, steel dynamics might, not necessarily steel dynamics, but more like a U.S. Steel or AK Steel. The integrated producers are more likely to use the met coal when they, to produce steel. There's definitely a risk here as well because they're a really new company. They've only been around just a couple of years. Basically, it was a fund that went around. They purchased some coal properties, and they just started production on coal in December of 2016. And they expect to hit like 4.4 million tons, but not until 2022. So it's definitely, this is kind of a little more of a speculative one, but I like the coal angle, I like the steel angle, and I also like, and also I help write IPOs, and this is what I wrote up, and it reminded me of another coal play that didn't do so well, the CNXC, that it priced poorly. They even cut their offering size by 40%, and the offering just was horribly priced. I think it was about a year ago. The stock fell all the way to 6, and then it rallied back to 16. So it's definitely a, I'm not sure this is going to do that for sure, but I do like that Met-C, I don't think it's on many radar screens because it priced, I think, around $13.50. It traded to $14.50 initially, or $14.78 was its high, and now it's trading under 11. So I kind of like it as a play just on coal, steel, and just it's more of a sentiment play. I mean, this one I can't justify with the financials. They don't really have financials at this point. And I would definitely put like a stop loss on this one, maybe around the $9 area. I wouldn't hold it if it goes into the mid-single digits or anything like that. But it just had a few features that I liked, and I liked the pullback, and I liked that it's not a loved IPO at all. Those are the ones I love the most. So I just wanted to at least put it on your radar. Definitely more on the speculative side, but I think it's definitely worth at least mentioning to you. So I wanted to get it out there. And trying to see if there's, and then so that's really about it. I'm not seeing any questions. Again, this is my first webinar. Maybe I'm messing up how the questions work here. But if anyone has any questions, feel free to email me directly at rreid@briefing.com. Again, my ticker is FUNDX. You can set up alerts so you get an email generated to your email that will tell you anytime I post a comment or anytime we mention FUNDX at all, you will get a an email in your box. So that's definitely a good way to do it. You can do that under the Portfolios and Email tab at the top. If you go through InPlay, I imagine you're going to be on InPlay a lot. So you can do that as well. But so we do have a question. We're saying someone asked if we have any good defense or homeland security plays for Trump. I don't really follow that. It's funny. I remember after 9/11, I could list all 10 of those. I know there's MAGAL secure like MAGS. I knew all the bomb detection ones off the top of my head, but unfortunately, I don't really have any good homeland security plays. I mean, defense, I do like Boeing. I mean, I think it's, obviously they have a lot of commercial experience, commercial exposure as well, but they do have a big defense area as well, and that stock's just been great. I write the, I publish the yield leaders report every Friday, and I've noticed that Boeing is coming on that list quite a bit, and what that list does, it sorts it by dividend yield, and also it has this thing called shareholders yield, which basically means how many shares is a company buying back, and divided by the number of shares outstanding. So it's kind of, it creates a yield of how aggressively management is buying back stock. And I do notice Boeing has gone up that list quite a bit. So if I was going to pick one, there's that. I also remember that Lockheed Martin also came on the list this week as well. I don't have the report in front of me right now, but I do remember those two. I was looking at some defense names, and I do like Boeing. It's probably my favorite one because it was high up on that list, and obviously there's a great company just in general. So So anyway, so I guess we will leave it there. Again, if you have any questions, please feel free to call me or email me is probably the best way to get a hold of me, rreid@briefing.com, if you have any follow-up questions. Anyway, I want to thank everyone for joining. And again, we're having our next webinar is going to be a live roundtable discussion with a Q&A session with the Briefing Trader team. That's going to be on Thursday, March 16th. I know that's the first day of March Madness, but try to pull yourself away from the games a little bit. Because it's going to be a great discussion. Event, chart, and tech tea are all going to be available to talk to you. So hopefully, get their discussions, their market themes, their strategies. It should be a good webinar to listen to. So with that, I just want to thank everyone for joining. And if you have any follow-up questions, just to send me an email. Okay. So thank you so much. Have a good day. Bye bye.